Good morning and welcome to the morning call for Tuesday, the 7th of March, 2017. I'll get to the RBA in a minute. Just a few things to sort of look at what happened over the last 24 hours. US was very flat. However, what I really wanted to highlight was what I told you yesterday, which is that basically March rate hike from the Fed is now factored in. Having a look when it did open and having a look at the interbank market, it moved up to 94% chance of a rate movement to the upside, and that is therefore basically saying that it's baking in. There's a small hedge just to make sure that on the off chance it doesn't happen, it's there, but basically at 94% in this kind of market is telling you it's going to happen. That compares with this time last week where it was sitting at around about 29.3%. So big movements there, and clearly the market has woken up to the fact the Fed is going to move rates. Other quick thing before I move on to the RBA is also around what's going on in our market. There is a huge amount of dividends coming out today. There's a plethora of them, around about 13 different individual stocks. The adjustments already happened, and it can explain why you see behind me the market looking a little bit weaker than probably on the open. So that brings me to the RBA. Today is obviously their March meeting. We are not going to move rates. That's also a given, considering the market here on the intermittent market side is pricing in around about 3 to 4% chance, which again is basically saying it's not going to happen with a small hedge inside of it. But what will be interesting is how Philip Lowe now goes around talking around the possibility of normalization of monetary policy. It's unlikely he is going to have the ability to do that, considering that we know at the moment that if you look at debt to income, it's sitting at around about 106% on a private consumption basis. Wage numbers are very much welded to record lows of 1.59% year on year in growth. And then if you look elsewhere, however, GDP is very strong, consumption is starting to move up, PMI numbers here in this country are also moving, and there is signs that employment is actually improving. So he's got these really push-pull factors, and that's a very interesting dilemma for him to be in, because it also therefore means that realistically, if you look at the overall sort of movement of the economy, we should probably be seeing rates raise higher, but that's not going to be the case, and therefore he is out. So how he allays that today, how he actually talks about moving monetary policy in the right direction over the next couple of years will be very interesting. He has been handballed, for in our opinion anyway, a bit of a hospital, considering those last two rate cuts that happened a year and a bit ago have probably actually put him in a bit of a bind in the fact that he's got no room to move to the downside, and that if you actually raise rates, you're going to see a little bit of consumption squeeze, and that's going to slow the economy down. So that's what you want to look today. What that does mean, and from a trading perspective that you really need to look at, is the Aussie dollar. The Aussie is very much, and I've talked about this for the last couple of weeks, trading on a fundamental basis, and that therefore brings me to the second part of today, which is China. Their GDP figures that we spoke about yesterday have clearly not impacted the market at all. In fact, if anything, the Aussie's actually moved up ever so slightly. It did get back above 76 cents, and that clearly shows you that the fundamentals are driving it. Current account, trade surplus numbers, the export numbers that we currently have are all very positive, and in a 3-month view you can see the Aussie is very much going to hold on to 75 cents even with a rate hike coming out of the Fed, and that is a very interesting sort of point indeed, because he does want the Aussie to be more around 73 cents rather than 75 to 77. So all that is something that you need to be wary of, something that I'd be very much watching very quickly, because it could change quite fast if you did see a slowdown in bulk commodities. But that's where I see the market at the moment. It's a very interesting thing. I know you've got to work so much harder at the moment to get that sort of small bit of profit than you used to sort of have to get, but that unfortunately is the market we have. It is very much still grinding higher. If you have any questions or you do want to discuss that even further, don't hesitate to call in 1-800-601-722. I am sort of having a lot of discussions around those sort of couple of points at the moment, so please don't hesitate to call in. Otherwise, have a good trading day. See you tomorrow.